When there's a really strong bull market, people tend to think, I just want to own the stuff that's going up, the hot area, that's where it is. And then a bear market comes along and humbles all of us, and then people see the benefits of diversification.
Morningstar's longtime mutual fund maven Russ Kinnel on how to choose the best mutual funds for your portfolio.
Funding provided by ClearBridge Investments, First Eagle Investments, Royce Investment Partners, Baird, Matthews Asia, Strategas Asset Management, and Women Investing in Security and Education.
Hello and welcome to this edition of Wealth Track. I'm Consuelo Mack. One of the most difficult jobs investors face is choosing the best mutual funds to meet their long-term financial goals. It is a daunting task, but it is one this week's guest has dedicated himself to for nearly 3 decades. Russell Kinnel is Director of Manager Research for Morningstar Research Services, a wholly owned subsidiary of Morningstar. He heads the firm's North American Morningstar Analyst Ratings Committees, which vet the Morningstar Medalist Ratings, which we cite often on Wealth Track. He is the editor of the monthly Morningstar Fund Investor newsletter, writes the Fund Spy column for Morningstar.com, and has published numerous studies on the mutual fund industry. As his bio says, quote, since joining Morningstar in 1994, Kinnel has analyzed virtually every type of fund and covered the most prominent fund families, end of quote. Now, recently, Kinnel published 2 particularly impactful articles. His very popular annual Thrilling 33 list, which narrows the universe of 15,000 fund share classes to between 25 and 50 funds that meet a few simple and strict criteria, and his review of the top 10 holdings in his personal portfolio. Interestingly, not all are members of the Thrilling 33 list. My first question to him, how does a fund make it onto the Thrilling 33?
The idea of the Thrilling 33 is just to set a very high bar on just a few questions and see what comes out. I start with fees because that's the most important always. A fund has to be in the cheapest quintile. Then I move on to manager investment. The manager has to invest over $1 million of their own money in the fund. Medalist rating, it has to be bronze or higher. Our medalist ratings are essentially tell you that we think this fund will outperform on a risk-adjusted basis over the long haul, so bronze, silver, or gold. It has to have an above-average parent rating because the parent company is an important piece of the puzzle. It can't have a high risk rating because we think the really volatile higher risk funds are a lot harder for investors to use well. And finally, it's got to have a minimum investment of $50,000 or less, so because I don't want to just recommend events of institutional funds for investors that you can't actually get, because that's frustrating. No one likes that.
We're still talking about, what, 15,000 different share classes that this... And then it narrows it down to like 25 to 50 in the 15 years that you've had it. That's incredible. So it's amazing that these criteria are so hard to meet. And I was also intrigued by the fact that fees, you said they're most important. Why are fees, low fees, the most important standard?
Well, I come at it from 2 reasons. One is just they're reliable, and that is next year might be a growth year, a value year, might be a bull market, a bear market. Fees impact every single year. So one fund's charging 40 basis points, and others charging, say, 1.5%. That 40 basis point fund has got a 110 basis point advantage every single year. So it's just consistent, and that compounds over time. And you really see that if you look at over a long time period. Fees just are a very good predictor, as the late Jack Bogle would, of course, tell us and illustrated so well. And then it's just simple math that, again, you get the returns after fees, you get the income after fees. And I think one reason it's a little counterintuitive for people is we tend to think, well, the more I pay for a house or a car or a sweater, the better I get. But what you don't necessarily understand is there's economies of scale, so that fund that's charging 50 basis points might actually be taking in more money to pay the managers than the one charging 150. You think of kind of like a Toyota or a Ford, they have those economies of scale, and so they can make a very good car for $40,000, whereas someone making 50 cars couldn't possibly do that.
Russ, I'm also intrigued by the manager must have $1 million in the fund, and I know that you feel very strongly about the manager should eat his own cooking. It should be vested with the interest of the shareholders. Why is $1 million kind of the magic number?
Well, that's the highest the reporting range goes. The SEC
Oh,
set
okay.
this rule in place 20 years ago, and they picked $1 million as the highest. If we're up to me, you would simply tell people how many shares of the fund the manager owns. Just the way with the CEO of a company, we know
Sure.
exactly how many shares they own.
The Morningstar Medalist Ratings, you oversee the committee that decides on what the medalist ratings are. As you said, the bronze, silver, or gold. So how are they chosen, and how predictive are they of performance?
They're chosen based on a mix of fundamental and quantitative factors. We have over 100 analysts worldwide who are evaluating the fund company parent. We often do fund company parent visits. They're evaluating the manager, they're evaluating the strategy, and so they rate all of those in a fundamental basis, and it's obviously their opinion, and they bring all of those to the committees, which then vet those to make sure that we're being consistent, that we haven't left any important stones unturned. We want to make sure that all key bases have been covered, and so that flows through. And then on the quantitative side, we estimate what's the alpha potential for an asset class, and then we also factor in fees. So we look at these ratings on these pillars, and then we have our alpha factor, and then we subtract fees to come up with the overall rating. And so there's kind of a mix of qualitative and quantitative.
How predictive are those of performance, are the medalist ratings?
Our performance has been pretty good. Not always great, but it's been pretty good. It did particularly well in a year like 2022 because we care about risk-adjusted returns. So when you have a bear market, you'll see a lot of our highly rated funds holding up better than their peers.
Parent pillar, and I know this is something that you emphasize, a lot, and it's one of your criteria. And I was intrigued that there are several funds that have come up in the Thrilling 33, several fund families, and as a matter of fact, 27 of the 33 for the most recent list are from are the same parent companies. I mean, American Funds, Baird Funds, Dodge & Cox, and Vanguard. So why are the parent companies of these funds so important?
For a lot of reasons. I think when you initially start researching mutual funds, you might just sort of think about this manager and that strategy.
Right.
But the longer you spend looking at the industry, you realize that over time, that parent company is really going to have a lot of influence. And so part of it is setting fees, but even more so, it's about leading the managers, the ethics behind it, but also what's the culture? Do they hire good analysts and managers? Are they able to retain them? You mentioned like a Dodge & Cox, they're very good at retaining people. A Vanguard, obviously a leader on fees and doing what's right for investors. So really there are a bunch of factors, but at the end of the day, the parent is very important.
Another criteria that you mentioned, so the returns greater than the category benchmark over the manager's tenure for a minimum of 5 years. So explain how that works. And when you're talking about a benchmark, I noticed that Morningstar is creating its own benchmarks, and then there are market benchmarks. So which benchmarks are you matching these funds against?
Oh, that's a good question. So for each category, we assign a benchmark, which is one of the best fitting benchmarks. And then we compare that fund's returns over the entire tenure of the longest tenured manager on the fund. So if the longest tenured manager is there 23 years, the fund has to have beaten that benchmark over the whole 23-year span. If it's 6 years, then it's 6 years, but it has to be at least 5. So if the manager's only been there 3 years, then then you can't make it in. And the basic reason there is just that there's a lot of noise in short-term performance. So long-term performance is a much better measure.
15 years in, what kind of turnover have you had in the Thrilling 33?
Typically, there's about 2 to 5 funds that go in or out in any particular year. And sometimes funds will leave and then come back, like Fidelity Contra Fund came back in after being out for a couple of years because its fees had come down relative to its peer group. Therefore, there's a fair amount of consistency, especially within those dominant fund companies.
So how have the Thrilling 33 done?
When you look at that mix of good management, low fees, solid performance, it's not a guarantee that you're going to outperform over the next 5 or 10 years, but generally you get pretty good results.
If we were to look at the Thrilling 33, are there a couple of funds in it that epitomize what it represents?
Absolutely. I think of a fund like Dodge & Cox International. Again, it's they're charging less than most foreign funds, and it really works into Dodge's wheelhouse, and that is managers and analysts tend to make an entire career there, and so you've just got tremendous stability, and that means that the approach doesn't change, but also the people don't change very much, and they're able to attract really good people so that the fund just is a very great fundamental driven fund. They're just consistent value investors, very much bottom-up investors. And so when people envision what is a manager doing when I hire them to pick stocks, it's probably not too far from what Dodge & Cox is actually doing. They're very much digging into all the fundamentals, going out and visiting the fund companies and building a good model and working collaboratively. So the analysts and managers are working together to arrive at a consensus and to build a portfolio of good value stocks.
You periodically, every couple of years, publish what you call my top 10 holdings, which is of great interest too. And I did notice that not all of the holdings are members of the Thrilling 33. Well, how come?
That's not a fair question. No, it is a good question. Well, I would say, first off, all of my holdings are medalists, so that means that they are.
Okay.
But also, I tend not to make many changes to my portfolio. So if, for instance, a fund slightly fails one of those tests, it might still be a very good fund. It just has fallen out slightly. Also, I think as you want to build a well-diversified portfolio, there are sometimes entire categories that don't have a single representative in that Thrilling 33. So again, if, say, there's no short-term bond fund or no emerging market stock fund, I still want to own one of them. So philosophically, they're very close.
One of your criteria has been to have balance between different asset classes. Do you want to tell us a little bit about that, what your approach has been?
Absolutely. First off, I'm a bit of a contrarian, so that if value or foreign equities are out of favor, I tend to think even more highly of them, so I may rebalance into there. So I also just believe in diversification, partly because I think the underperforming areas are probably have a better chance of outperforming the next time period, but also I recognize that it's very hard to predict. If you look at the history of rallies and bear markets, they often hit one side of the style box a lot harder than the other. At the moment, this year, growth is doing much better than value. Last year, value did much better than growth. U.S. versus foreign tends to run in 10-year cycles. The last 10 years, the U.S. has dominated. The next 10, it might be foreign. I also think fixed income, as I'm getting a little closer to retirement, hate to admit that, but it's true. Fixed income is also a valuable thing, and makes bear markets a little more tolerable. So I think diversification is really valuable. When there's a really strong bull market, people tend to think, I just want to own the stuff that's going up, the hot area, that's where it is.
Right.
And then a bear market comes along and humbles all of us, and then people see the benefits of diversification. So it just that's really my approach.
What percentage do you have in international versus domestic in stocks?
Yeah, I've got about a third of my portfolio is in foreign equities and bonds.
You also say that you're agnostic on active versus passive. You own both. The world has changed a lot, and passive funds have really caught on tremendously. Your life has been dedicated to actively managed funds. So, are you really agnostic, or have you changed your mind about actively managed funds, considering that the vast majority continue to underperform the indexes?
Well, I think the same principles apply for both active and passive. In other words, either way, you need a good strategy, you need low fees, you need competent management. I guess, yeah, I think to some degree, maybe I've tilted a little more towards indexing, but I've always been a fan of indexing. Back in the late 90s, before ETFs came to the fore, it was really just Vanguard out there promoting indexing, because none of the brokers out there knew how to make any profit from selling index funds. Then along came ETFs, and it's like, well, I can get a commission on these just like stocks, and all of a sudden things change. But I think even then it was obvious that costs matter. And if you look at cheap actively managed funds, you can find a fund like a Vanguard Wellington or even a Dodge & Cox stock that are under 50 basis points. Yes, ETFs are a wonderful long-term investment, and I kind of think of them as, it's like on the front they're kind of this old-fashioned bank with the great Greek pillars, and you can come in, but on the back end they're a casino. You can trade very niche-y ETFs all day long, like you're in Vegas, or you can buy these low-cost, broadly diversified ETFs and just hold on to them for 30 years. So, ETFs kind of magically have it both ways.
Looking at your top 10 holdings again, I know that you listed them according to the weight in the portfolio. So the largest weight is Vanguard Prime Cap Core. What is it about Vanguard Prime Cap Core that has made you give it the largest weighting?
I own 3 different Prime Cap funds, in case you're wondering how much I like Prime Cap. I've got one in my 401k, I've got one in a Roth IRA, and I have this taxable fund. So what I like about Prime Cap is they're just very good growth investors. Some growth investors are kind of momentum investors. You talk to them, you hear a lot of buzzwords, and there may not be much beyond that. But Prime Cap goes very deep. Prime Cap is great at bringing in elite investors and keeping them their whole careers. Prime Cap's kind of unusual in that when they go out scouting to hire some new associates to their firm, they're not interested in how well they build their stock models or what their track record is. They just want to hire the smartest people, bring them in, and then just say, here, go to work. This is your industry. Figure it out yourself. Their track record is just outstanding.
Let me ask you about some of the funds that you own that are not in the thrilling 33, and also are not the repeat parent pillars, which does not mean that their parents are not great companies. It's a different asset class. The PIMCO Total Return Fund.
PIMCO Total Return is a very good institutional fund. If you can get the institutional share class, it's a pretty good value, but it doesn't necessarily qualify on my test for being a minimum under 50,000. But PIMCO, I think, is really elite when you think about all of the tools they bring to bear in fixed income investing. So they have great quantitative people, they have great sector specialists, they have great managers, they have great traders. All those are really important tools to have at a complicated bond fund like this. And so if you look under the hood at PIMCO Total Return, it's a complicated thing. There's bets on various foreign bonds, there might be currency bets, there's all sorts of derivatives going on in there. But at the end of the day, it's a firm that's very good at managing fixed income portfolios. Lately, it's reined in its bets a little bit, so performance has been kind of middle of the pack. But I think that's a temporary thing. I don't think they're going to do that for the long haul.
I'm going to ask you about a couple of more funds that are not in the thrilling 33, and also that are very unusual and kind of unique funds as well. One of them is Oakmark Select, which is managed by Bill Nygren, a very famous fund manager. It had a very rough 2022. What's your thinking about holding Oakmark Select for the long term?
Yeah, this is a fund that I've owned for a very long time, and as you imply, I think with any focused fund, you really have to be ready for ups and downs because this is a fund, and you can really see it. I think just look at the calendar year returns, and you can see what's going on. Is the fund will put together, like this year, it's having a great year. Last year had a terrible year, but Bill Nygren is just a very good value investor who, over the long haul, has compounded returns at a very high rate. He's a fairly flexible value investor. So there's a lot of different holdings that go in there. So you definitely have to understand that. So even though it's in large blend, it's a totally different animal from, say, total stock market index fund, which has very reliable performance. This one's going to have more ups and downs. And so you have to factor that in when you own it. You have to think this is a really long-term holding. I'm going to own it 10 years or more. Otherwise, it might not be the right fund for me.
The last one I'm going to mention is one that we've had on featured, Charlie Dreyfus, and that's the Royce Special Equity Fund, and that is certainly a special fund. You've owned it for a long time too. Why?
Yeah, you'd think with all the thousands of funds out there that there would be 10 versions of everything, but yeah, there's really not many funds trying to do what Charlie Dreyfus and the rest of his team are doing, which is looking for clean accounting, clean balance sheets, reasonably priced companies with good cash flow. So operating all in that small value space. And that kind of clean accounting thing means they avoid blowups, but also accounting really comes to the fore in recessions and bear markets. And so again, like in 2022, this fund lost a lot less than its peers because that emphasis on accounting and balance sheets. And so I think it's a wonderful diversifier. If you've got some aggressive growth funds, a lot of large cap, this is a fund that's going to behave differently. And that there's a real value there. If you talk about what's the value add of active management, well, here's a great example. Charlie Dreyfus and the rest of his team really digging into the accounting of all their companies to find out who's being a bit of a weasel or who's really being honest and giving a fair accounting, and therefore you really can rely on those companies.
You just shared some of your top 10 holdings, Russ, but we ask at the end of every Wealth Track, if there is one investment we should all own some of in a long-term diversified portfolio, which you own, a long-term diversified portfolio, what would it be?
If I had to pick just one, I might pick something like Dodge & Cox Global, because I think global funds, they're not very appreciated, but again, it makes sense in a way, don't you think, to invest in the whole world so that a manager can find the best bank or the best telecom or the best pharmaceutical company, regardless of where it is. Dodge & Cox has that ability. We've seen they're very well proven in both U.S. And foreign. And so I think it's a really good fund. It's got low costs. We know that costs matter over the long haul. It's a firm. When you leave the firm, you have to sell your shares back in the firm. So what that tells me is Dodge & Cox isn't going to be sold to some mediocre colossus and see all of its talent run out the door. They've got a mechanism set up to ensure that it keeps going. And so if I had to go away from 10 years without looking at my portfolio, I'd still have a lot of confidence that that fund would keep doing its job and keep earning me a nice return.
Russ Kindle, thank you so much for joining us on Wealth Track. It is really a treat to have you on.
You're welcome. I had a great time.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is pay attention to mutual fund costs. Morningstar's extensive research has concluded that costs matter for both passive and active strategies. In a recent assessment of active versus passive funds performance in the 10-year period ending in 2022, it found that the cheapest funds succeeded more than twice as often as the priciest ones, a 36% success rate of beating the benchmark versus 16% for the most expensive funds. And the cheapest funds had a superior survival rate, 67% over the decade versus 59% for the most expensive funds. Costs matter, as the late, great Jack Bogle, the king of low-cost index investing at Vanguard, told us. There is one certainty investors can count on. Quote, you get what you don't pay for. Next week, we will sit down with the incomparable Burt Malkiel celebrating the 50th anniversary of his investment classic, A Random Walk Down Wall Street, why it has stood the test of time. In this week's extra feature, Russ Kindle shares how inspiring Vanguard's Jack Bogle was to him and the Morningstar team. Please follow us on Facebook, Twitter, and our YouTube channel. Thank you for watching. Have a re-energizing weekend and make the week ahead a healthy, profitable, and productive one.